Fund Supermart, your online gateway to unit trusts.
Hi Christiaan, can you briefly explain the investment concept of volatility management and how it works?
Yes. So if you look at volatility or equity volatility is a nice diversifier to equity investments. So what you do basically, you take exposure, short or long equity volatility according to the market cycle. And when markets get, during market turmoil, it can be very beneficial to have long volatility exposure, to buy volatility, because it's a very good diversifier. When equity goes down, volatility goes up, so it's a good diversifier in your portfolio.
How does Seeyond Equity Volatility Strategies aim to deliver investment performance?
Okay, so what we're trying to do is we separate the markets in two environments. A first environment, which is a normal environment, okay, a normal environment of growth or flat markets, where there's not much risk in the market, in which we aim to perform a moderate growth, 0 to 4%, okay, of uncorrelated returns. Okay, they diversify nicely in your portfolio. And then the second state of the market is a crisis environment. In a crisis environment, we aim to buy volatility and basically provide returns above 10 to 15% to provide for diversification. Okay, when the rest of your portfolio is going down, equities, but also fixed income. Equities and fixed income have been correlating much more. So traditional portfolios need to have an additional source of diversification. And that's what equity volatility can do, because it diversifies when markets are in turmoil.
How should investors view this fund as an allocation within their portfolio? Is it considered an alternative investment?
It's clearly an alternative. It draws, so what we like trying to do is provide an alternative source of returns, but from traditional asset classes. Okay, you're investing into equity volatility. Okay, but basically this is just futures and options, listed and centrally cleared futures and options. So you don't want to add any counterparty risk or any banking risk into that. You invest into instruments that are centrally cleared to provide an alternative return during normal markets and crisis alpha during times of crisis.
What are the reasons for the fund's underperformance year to date?
So what you're looking at, if you look at the year to date, basically we've got, or maybe one step back, if you look at the markets at the moment, you've got a lot of systemic risk in the markets. Okay, we've got political risk, we've got elections coming up, we've had some events of political risk in Europe as well with the Brexit, but also we're at the end of a cycle positioning. So in those environments, we want to be long volatility. We want to it works like insurance. If you're long volatility, you're basically buying a premium, okay, to protect you against market downturns. And what happens, basically, we protected very nicely through the event of Brexit, but we still see too many systemic risks in the market to take our long volatility position off the table, and that can cost. It's like paying an insurance premium, and it's cost a little bit, especially since June, a couple of points of performance. But all of that in a bull market, in a market where equity have performed quite nicely. If we look at today, we don't believe that. We believe that the risk in the markets are undervalued. Okay, and because of this risk, we keep a long volatility exposure in our fund, because we do believe that we need to provide diversification for our investors.
What is the outlook for the volatility regime going forward? How is the fund positioning itself for the volatility regime?
Okay, for the volatility, so we're clearly in a volatility regime. When I separated the markets earlier in kind of a normal environment and upcoming to a crisis environment, we're clearly in that second stage. Okay, we believe that we're at the end of a cycle in the US. We've got a lot of risk on emerging markets. There's political instability in many emerging regions, but also in Europe. So what we're doing is that we're buying volatility in the fund. We're long volatility. When you're long volatility and the volatility spikes, your fund is going to return positively, and that's what we've been promising to our investors, and that's what we're looking to provide if we go into a market downturn.
Okay, thank you.